Welcome to Washington, D.C. It's a beautiful spring morning in Washington, D.C. We're here with the Governor of the Bank of Canada, Tiff Macklem. It's been a great honor, pleasure to have you here with us. I'm going to give a little quick introduction. Governor Macklem's a proud son of Montreal. He's been in public service for around 40 years, so I presume that means he started at primary school. He's been at the Bank of Canada as a deputy governor, senior deputy governor. He was at the finance ministry during the financial crisis and came back to the Bank of Canada recently as governor, right in the middle of the pandemic, perhaps one of the most difficult times to join an institution. He was dean at the business school at the University of Toronto, and great to have you with us here today. So maybe we could start, you could set the stage with us, just give us a sense. I know you had the policy meeting yesterday, so a sense of how you're seeing things from the top of the Bank of Canada.
Well, first of all, thanks, Nigel. It is a real pleasure to be here. These spring IMF meetings come at a good time. There's a lot going on in the world, and I'm looking forward to comparing notes with my colleagues and learning from each other. As you alluded, we actually had a policy announcement yesterday morning, our most recent monetary policy decision, and so I thought I'd just take a few minutes to highlight what we decided, what's on our mind, and how we see things going forward. So the bottom line is the bank maintained our policy rate at 4.5%, and we also continued our policy of quantitative tightening. Just to remind you the path we've been on since March of last year through to January of this year, we raised our policy rate in 8 steps. Some of those were quite large steps for a total of 425 basis points. And since January, we've said we want to take some time to assess how the past interest rate increases are working their way through the economy. And the question, of course, that's on our mind is whether monetary policy is sufficiently restrictive to return inflation to the 2% target. In many ways, Canada has faced the same inflationary pressure that the rest of the world has faced as we've come out of the pandemic. Among advanced economies, we were among the first central banks to raise our policy rate, and we've raised them very quickly. By front-loading our monetary policy tightening, what we wanted to do was really try to minimize the likelihood that an inflationary psychology would set in. And by keeping inflation expectations well anchored, what we hoped is that we could avoid the need for even higher interest rates going forward. So far, I'd say it is working. In Canada, inflation has declined from about 8% last summer. Right now, it's about 5%, and we think it's going to be about 3% this summer. The Canadian economy is expected to grow modestly even as inflation is coming down. This is good news, but I would stress it's not job done. Our destination is the 2% inflation target, and there are several things that have to happen to get inflation all the way back to the target. Inflation expectations need to come down further, service price inflation and wage growth need to moderate, and corporate pricing behavior needs to normalize. Coming to the economy, global economic forces are very important to Canada's economy. We're a very open economy. 35% of our GDP is exports. And we are expecting that our biggest trading partners, particularly the U.S., will slow further with successive interest rate increases. And recent global stresses in banking have tightened credit conditions, and that will contribute to weaker growth, mostly in the United States. That will have some impact in Canada. The other thing we're seeing globally is that pretty much everywhere, headline rates of inflation are coming down, but core rates of inflation are proving more persistent. In Canada, our economy remains in excess demand. The labor market is still tight. Unemployment is still very close to a record low. We can see past interest rate increases working their way through the economy and restraining demand. You see that particularly in housing and in big ticket items. So what does all this mean for inflation? CPI inflation declined to 5.2% in February. That was really led by falling goods prices. declines in energy prices, base year effects, normalizing of supply chains, and the effects of restrictive monetary policy and interest-sensitive sectors. We do see more easing of inflation ahead as the economy slows, as the labor market comes into better balance. We expect to see service price inflation decelerate and our measures of core inflation move down further. If you look at the three-month rate of headline CPI inflation, it's running at 1.6%, so that does suggest that we're going to see further declines in headline. We expect to get down to the 2% target by the end of 2024. In our policy deliberations this week, my colleagues and I on the Governing Council discussed whether we'd raised rates enough. We also considered the likelihood that the policy rate may need to stay restrictive for longer to return inflation to the target. We're very conscious that monetary policy works with a lag, and we know that the full effects of the tightening cycle that we've already put in place have not fully worked their way through the economy. We're also mindful that there are risks around the projection, and I thought the WEO was very thorough in its assessment of the various risks. I think from our perspective, the biggest upside risk is the one I've mentioned, that service price inflation could be more persistent than we've projected. The key downside risk is a global recession. There's more than one way that could happen, but certainly the recent banking stresses have reminded us that if we see more intense stress in the financial system, credit conditions could tighten significantly, and that could result in a more severe global slowdown and lower commodity prices. Finally, I'd stress that our job at the Bank of Canada is to restore price stability, and that means getting inflation once again centered around our 2% target. We are encouraged with the progress we've seen so far, but the job's not done, and really our commitment is we're going to stay the course and we're going to complete the job.
Great. Thank you very much. That was very, very thorough. Maybe I'll just pick up on a couple of the themes, which I think resonate also with some of the global themes we have here at the spring meetings. As you said, job's not done. There's been a lot of progress on headline inflation. Core inflation in Canada is still around 5. And I think that's generally globally. There's a lot of stickiness in services inflation and core inflation globally. How worried should we be, both in Canada and outside, that we're going to get stuck at inflation somewhat higher than targets? Not as high as we've seen, but higher than the central banks would like.
Yeah, so, I mean, as I was just saying, our inflation forecast, we have inflation coming down pretty quickly to 3%. This summer's not far away. We then expect it's going to decline more slowly, down to 2%. And as I said, there's some things that are going to have to happen. Inflation expectations need to come down. Well, what are we seeing? Well, inflation expectations, near-term inflation expectations, they are coming down, but they haven't come down. They're still higher than our own forecast of inflation. They're going to need to come down more if we're going to get inflation down to target. Wage growth in Canada is running about 4 to 5%. Unless there's a surprisingly strong pickup in productivity, that's not consistent with our 2% target. Service price inflation also roughly in that range. We need to see wages decelerate. We need to see service price inflation come down. And then the other thing I'll mention is corporate pricing behavior. If you look at what happened when inflation went up, what you can see very clearly in the price data is that the frequency and the size of price increases that companies were pushing through went up a lot. You're starting to see that come down. But the reality is, when the economy is in excess demand, and our economy is still in excess demand, companies and people expect inflation to be above the target. It's too easy for companies to pass on these price increases. We are starting to see that normalize, but when you talk to companies, you still hear from them that they've got some cost pressures and they still intend to push those through. So those things need to normalize if we're going to get inflation all the way back to the target. And that's going to happen gradually, and I would agree. There are, we did highlight that as the biggest risk on the upside, that that could go more slowly. We could get stuck, and certainly what we underlined yesterday was that if that happens, we are prepared to raise interest rates further because we are committed to getting all the way back to the 2% target. I'll just say one other word. Why is it important to get back to the target? I mean, in Canada, we've had a 2% target now for roughly 30 years, and it has served the Canadian economy, Canadians, very well. We have a band of 1 to 3, but what I would stress is that band, it's not a zone of indifference. You need to aim for the middle of the band if you want to be in the band most of the time. So we need to get inflation recentered on 2% so that the normal variation of inflation is between 1 and 3. That's important. Low inflation reinforces those competitive forces. When companies know that people are expecting low inflation, they are going to be more cautious about passing through price increases. There's a bit of a self-stabilizing element. And the other thing is, if you've got inflation centered around 2, people can plan. They can plan their spending, they can plan their budgets. They can do that with confidence that their money is going to hold its value. So for all those reasons, it is important that we get inflation back centered on the 2% target.
Absolutely. So for Bank of Canada, close enough is not good enough, right? You have to be at the midpoint of the target. Let me turn a little bit to how you've seen the monetary cycle play out. As you said, you tightened quite early and quite quickly. But then again, this was a very unusual cycle. The pandemic hit, we had a very sharp shutdown, a very fast opening. Strange things are happening in labor markets that we've probably not seen before. Do you think the monetary transmission mechanism in Canada has changed, or are you seeing things you didn't expect in terms of the responsiveness of the economy to higher interest rates?
Well, I guess where I'd start is, as you said, everything about this cycle has been tremendously unusual. And central banks have had to cope with that. Canadians have had to cope with that. Businesses have had to cope with that. In terms of our tightening cycle, when we saw that domestic price pressures were really building, we did move rates up quickly. We were actually, I think we were the first major central bank to stop QE, and we were certainly among the first and the fastest to raise interest rates. In terms of typically we think that the full effect of monetary policy on inflation takes 18 to 24 months. And what we're seeing so far, I would say certainly some parts of the economy, it's having much faster effects, and actually that's not surprising. Housing, very interest sensitive. Housing has slowed very sharply. You're also seeing it in the purchases of things that people often buy on credit. So furniture, for example. You can see demand has slowed with housing, and inflation in durables in general is coming down. We like in Canada, we invariably compare ourselves to the United States. The mortgage market in Canada is somewhat different in the United States. The typical mortgage in Canada is 5 years. It's not 30 years. And we also have some variable rate mortgages. So what that means is when you raise interest rates, it passes through more quickly to households. So we do think, we are starting to see that pass through more generally to consumption. The other thing on our mind is debt levels, household debt levels in Canada are much higher today than they've been in previous tightening cycles. So you would expect, if you got higher debt, the burden of higher interest rates is bigger. You'd expect monetary policy to have more traction. On the other hand, the other thing, though, that has happened is through the pandemic, of course, people couldn't buy many of the services they wanted to buy, so they had what economists call excess savings. I don't think households think of it as excess savings, but more savings. They've got bigger buffers. So on the one hand, yes, they've got more debt, so there's more traction, but they've also got bigger buffers. So it's going to be, it's hard to see how those two things are kind of working in opposite directions. So far, I'd say it's hard to say that it's been faster or slower than we'd expect.
Okay. And one of the important things for the transmission is you want to influence financial conditions more broadly. I think we've seen of late quite a lot of difference of view between the financial markets and what central banks are telling the financial markets they're going to do. Is that a concern? Do you think this will sort of self-correct as we see more data or markets learn about the reaction function of the central bank?
Well, over my career in central banking, there's been a real change in thinking. I think, when I was in grad school, the idea was, monetary policy wants to be effective, it needs to surprise markets. And I think we've collectively really moved away from that. I think monetary policy works better when everybody understands it. They understand the objective, they understand what we're doing to achieve our objective, and they understand the transmission mechanism. Markets look at the same data we do, and certainly, we have increasingly been trying to provide more and more information so that markets understand where we think the economy is going. So, for example, yesterday we published our projection. It's quite a detailed projection of the Canadian economy. It gives the path for GDP growth. It gives the path for inflation. As new data comes out, markets can evaluate, is it coming out in line? Is it stronger? Is it weaker than our projection? And that gives them a pretty good idea probably what we're thinking. Another thing we've started actually recently, partly in response to actually a recommendation from the IMF, we recently started publishing a summary of our deliberations. And again, that, I think that gives the markets a little more insight into what was the Governing Council thinking as they deliberated on the decision. And over time, that should help them understand our reaction function. So, and I think that the more people understand the objective, how it works, the better monetary policy works, the more effective it will be. So, from time to time, markets and central bank may not be aligned in their expectations. And I think you have to ask yourself, well, why is that the case? If it's the case that there's a different view about the economy, I mean, that's information for us. Markets see things differently from us. Data's going to come out. One of us is going to be right. One of us is going to be wrong. There's going to be some convergence. And sort of understanding how the market sees the data, I think, is helpful information to the central bank. When it's a concern, though, is if you think markets don't understand our perspective, or even perhaps worse, they don't believe us. There's a credibility problem. So, that's why being as clear as we can about our outlook, putting out our summary of deliberations, giving speeches to regularly update Canadians and markets on how we see new developments. I think those things will, minimize any misunderstanding.
Great. And let me just pivot. One thing you mentioned at the beginning, and I think is on everybody's minds here, is this issues of financial stability, particularly after what's happened in the United States and Europe. How are you viewing the bank stresses? I mean, are you thinking of them as sort of an idiosyncratic problem of some investors who made the wrong bet? Is this a harbinger of something bigger that may even get into the Canadian system? How do you look at that picture?
Well, those are all good questions. I think this audience is very well aware of recent events, so I won't go through them in detail. But it's a very small number of banks who clearly had some serious lapses in risk management. The Swiss authorities, the U.S. authorities have responded quickly and forcefully, and that has stabilized. That has certainly limited contagion. Markets have restabilized. With respect to Canada, there's been, with generally credit conditions tightening, equity prices of banks down globally, you're seeing a little bit of spillover to Canada, but honestly, it's really been quite muted. I think we've had a long history of the structure of our banking system, has certainly had a long reputation of being quite stable, and our banks meet or exceed Basel standards. So we've seen very little spillover. There'll probably be some in the U.S. The regional banks do play an important role, particularly in lending to businesses. You are seeing some tightening, some more tightening there. The U.S. is a very important export market to us, so that probably will have some effect on the Canadian economy, and we've taken that into account in our own projection that we put out yesterday. Could there be future issues? Look, there could. In the last several years, we've seen a number of, to use your word, idiosyncratic shocks in the financial system, commodity market, issues in commodity markets, U.S. gilt market, Archegos, and then U.S. regional banks, Credit Suisse. And I do think we do need to be vigilant. It is going to be important that supervisors are really working with the institutions. Institutions are being diligent about their own risk management. And then finally, from sort of the central bank point of view, we have a lender of last resort function. And for better or for worse, in recent years, we've gotten more practice than we'd like to have had in using it. We do have a number of targeted instruments we can use. And if there is a serious global event, if markets were to freeze up, we are prepared to provide liquidity against good collateral. That is a core function of the central bank. If you look back, if you go back to the global financial crisis, there has been considerable strengthening of the system since then. Higher capital standards, higher liquidity standards, limits on leverage. That has certainly made the system more resilient, but we certainly don't want to be complacent. The financial system, like the rest of the economy, has to adjust to higher interest rates, and we do need to we do need to be ready for the possibility that there could be some issues.
Great, thank you. I think we have time to take a couple of questions from the audience. If anybody would like to raise their hands, and this gentleman in the front. Maybe we'll take two questions if there's anybody else would like to ask the governor. Maybe that gentleman at the back as well. Sir, please.
Hello, Governor. Alex from the Montreal Council on Foreign Relations. Given the independence of the Bank of Canada, but having no control over fiscal policy, what kind of discussions do you have with the federal and provincial governments, running substantial deficits? So what kind of discussion you might have regarding the effect of monetary policy if fiscal policy is not aligned with the same objectives?
Maybe just take the second question first, next, and then we turn it back to you, Governor, to answer. Thank you for your question.
Samir Trabilsi, Professor of Accounting and Governance at Brock University in Canada. Inflation has raised it so fast, and it has been even surprising central banks. Now the question, and the big question, is how central bank can mitigate this other than increasing interest rate. Is there any other alternative to the magic solution that is applied across the border, increased interest rate? Thanks.
Thanks. So question on fiscal, question on monetary tooling.
Well, maybe I'll take the second one first and then come back to fiscal. Our primary instrument is our policy interest rate. And we have a long experience of moving it up and down. So we have good estimates of the elasticities, the effects. Of course, every cycle is a little different. Certainly this one is more different than most, caused by a pandemic. So those are things you need to take into account. We also have some other extended tools, the use of our balance sheet. When we were at the effective lower bound, we used our balance sheet to, since we couldn't lower rates anymore, we used our balance sheet. We're now in a process of quantitative tightening. That's operating, I would stress that's operating more in the background in a quite sort of predictable way as we're letting maturities roll off, so our balance sheet is moving down. The with respect to, so those really are our instruments, and I would stress again that the primary instrument is very much the policy interest rate. Are there other policies that help? Certainly, improvements of supply chains, improvements in logistics. That those are coming through. That's certainly helpful. We're seeing the effects of that. That is helping. Bring goods price inflation down. So that's an example. I think more broadly, longer term policies that raise the potential growth of the economy, those we still need to make sure we maintain price stability, but structural reforms, improvements in productivity, increases in immigration, policies that support more labor force participation, those all raise the rate that the economy can grow sustainably without causing inflation. Those are policies that are beyond the central bank. And that this kind of links into your question on fiscal policy. So with respect to fiscal policy, we have a very clear mandate. Our job is price stability. Governments have lots of decisions to take. They have many priorities. They've got to balance those priorities and take their own fiscal decisions. Those decisions are really the purview of elected governments and ultimately parliaments. Those are not the job of the central bank. So we don't, we really have nothing to say on the government's choices about what they spend their money on or how much. What we do, though, is we take account of government's spending fiscal measures in our forecast. So the forecast we just put out yesterday, there's actually been a series of provincial and federal budgets since our last forecast. Those are incorporated. And what you see is that does add some spending in the economy. You can see that in our detailed tables. You can see the contribution to growth from government spending goes up. I would say that, so basically the bottom line is that government is contributing to growth. It's not a reason why we have growth slowing in the economy. It's not relieving inflationary pressures. At the same time, growth in government spending is broadly in line with growth and potential output. So it's not getting in the way of getting inflation back. And as I indicated before, even with those, after we built in the new fiscal measures, inflation does come down and it gets back to the target around the end of 2024.
Great. Thank you very much, Governor Macklem.
A pleasure.
Thank you for joining us at the Governor Talks. Thank you for being a great friend to the IMF. And thank you for your service to the Canadian people.
Well,